Good afternoon and welcome everyone to today's US markets update and second quarter earnings review presentation. Great to see so many on today's webcast. My name is Kelly Main, Associate Portfolio Manager, and with me today are Fortrend CEO Joe Forster, along with our portfolio managers Chris Wallerman and Stephen Lyle. We welcome question and answers throughout the presentation. Please feel free to click on the Q&A tab at the bottom of your screen to ask a question. We will do our best to answer it in a timely manner and as best as we can. With that, I will now turn the presentation over to Joe.
I strongly encourage the questions. It's a very different presentation when we have a live audience, and it's hard to not be able to interact with you in real time. The market just continues to move up and to the right with the impact, particularly of the Federal Reserve Bank buying assets, quantitative easing, creating liquidity in the market. The volatility index is relatively low at around 20, and the market just continues to go up. The market this month up 1%, while earnings estimates, surprising to me, up only 1.8% as the price goes up, and the earnings estimates go up at a faster pace. That brings the forecasted price earnings ratio down to 20.3. The 10-year Treasury continues to fall. So last month we talked a lot about whether inflation is transitory or sticky. And we talked about how it's probably transitory in some commodity sectors as we have a recovery in the economy that is causing some supply bottlenecks, but that it could be more sticky in the labor markets. If labor prices go up, it's harder to bring them back down. But the concerns about inflation are dissipating, and the 10-year Treasury yield fell to 1.22 from 1.42 and down from 1.62 the prior month, indicating that inflation is not a major concern. This quarter revenues are just screaming ahead for S&P 500 companies, up 23%. Consumer services, that means restaurants, hotels, anywhere where we have people in jobs servicing other individuals, we're seeing revenue going up. Oil, way up more than 100%. Revenue for banks fell, which is interesting because their profits surged as they profits surged. So we're getting profits up from the prior year, 89%, led by energy equipment. That's companies like Dover, Schlumberger, or Baker Hughes. And profits are also up significantly for banks, which had some big write-offs in the prior year. Is that a question, Kelly? No, it's not. Please ask questions along the way. Interestingly, profits are falling for household and consumer products on tough comparisons. And I, not happy, but proud to say that we did warn in this report, look out for Clorox. They had a great result last year. They're up to 23 times earnings, and the stock is down 10% last night. So we did see Reckitt, Berkshire down significantly as well. So we are seeing some very tough comparisons for personal products, whether that's the cleaning products like Dettol that's made by British company. Banks, interestingly, what we're seeing there is that they had taken some write-offs a year ago. They had written off some bad loans, and JP Morgan in particular wrote that back onto the balance sheet, saying those loans will perform. So what we're seeing is, and I'll go into this more detail, but lending books are down for the banks. They're making fewer loans, but they are making more money out of their trading in currencies or in bonds or in their investment banking departments, which are doing very well. So they're making good money at banks. The big movers in the market here, Albemarle, they get about a third of they're a specialty chemical company out of North Carolina. They get a third of their revenue from lithium, which is going into batteries for cars and many other things, with sustainability and the carbon footprint becoming a more important issue for many countries right now. We're seeing Albemarle surging on demand for lithium batteries. And there are three major lithium manufacturers in the world, which goes into the batteries. And Albemarle would be the best play to get into the growth in lithium battery markets. Chipotle, we invested in them when McDonald's spun them out at $20 a share. They opened at 40, and we invested in them. We had them for a long time, but they just continue to do very, very, very well. There's an app you can order ahead and go to the store and pick it up. But great burritos, great food. And I think the bottom line is it's really good food. So Chipotle is doing very well, and I wish they would come to Australia. Hillrom is a medical device company, and they're getting taken over. So a takeover offer for Hillrom, and they're up significantly. Going down the list here, I want to point out up 14% this month, Carrier, and going down towards the bottom of this list, Otis. Now Carrier makes escalators and other heavy equipment that goes into construction projects, and Otis, of course, making the elevators. So escalators and elevators are going into the construction industry. Both of these companies were spun out from Raytheon when they merged with United Technologies. So they're now having independent authority. The managers of these companies have the independent authority to run these companies the way they see. So they're like when we invested in Energizer or Dr. Pepper. It's nice to have a division that's been held back by the bureaucracy of a much bigger organization to be able to go out and do things their way and achieve results. So Carrier and Otis will probably continue to do very well. On the other one that's doing surprisingly well and continuing to do surprise me is Advanced Micro Devices. They of course are in the chip business, and they competed with Intel for the not the memory chips, the microprocessors to compete with Intel. And they got in a price war about 15 years ago, which resulted in them having to sell their foundry business. And now all they do is design chips. And Global Foundries is a separate company owned by hedge funds that could potentially be acquired by Intel now. But AMD is designing good chips, and they're selling them, and they're doing very well. Dover, I want to next go to Dover and Danaher. Dover, you're using their products all the time. At about 6 in the morning every Monday morning, there's this big truck that comes out in front of my house, and it's got these arms on it that lift the garbage bins and dump the garbage bin. That's Dover's product. Or when you're filling up your gas tank, your petrol tank at the gas station at BP, all those pumps and all those hoses, and then the whole kiosk, let's call it, is made by Dover. So Dover makes sucker rods that go into pulling oil out of the ground. So Dover is a good manufacturing company, and Danaher, of course, bought the dental products business from GE, and of course GE got the management out of Danaher. So we're seeing these companies really taking over from some of the market share from GE, some of the market share from Siemens, and we're seeing very good results out of the U.S. manufacturing companies at Dover and Danaher. On the downside, skipping Occidental, Tencent is down and continues to fall. We of course owned Electronic Arts in the video game market, and there was some news last night from China calling video games what they call spiritual opium. So we had talked about the addictive nature of these games. There's a couple other companies in this space. One called Bilibili, and another one called NetEase. Both of these stocks are down significantly on Chinese concerns about addiction for children in the gaming market and for young adults. But of course, we say that leads into Macau or into Las Vegas and gambling for adults. I think this is bad stuff. So Tencent down, we sold that around 70, it's around 50 now. It went up after we sold it, but it's down, and we're happy to be out of that. Also, Carnival, we're seeing other rotations with the spread of the Delta variant. I see that in the Wall Street Journal today, there's talk of needing a passport to be able to go into a restaurant or proof of vaccination. And so what we're seeing there is the spread of Delta is really causing rotation back out of some of those stocks that had recovered, but are now exposed to potential further lockdowns. Carnival is down, and some others. Also to the downside, this company Reckitt Benckies, they make things like Dettol or condoms or Finish detergent, which goes in your washing machine. So a lot of these consumer products got a big lift up in the beginning of the pandemic because everyone wanted to have cleaning agents. And now they're seeing very tough comparisons. So we're seeing some rotation out of oil as oil still comes back down, Occidental, Marathon, and Halliburton down, Apache down, Schlumberger down. And so some oil service companies are down as well. The earnings estimates, these are graphs showing the biggest changes in earnings estimates. And Occidental says it's up 170%. What's doing there is it's going from a negative, a forecasted loss, to a positive. So it's not like it's going to make a 30% margin. It might make a 2% margin. So it's gone from -1 to a positive 2% margin. But similarly with Marathon, big bump up in the oil companies' earnings estimates. But as we talked about BHP last month, what we're getting here is a big lag. So the stock prices are down and the earnings estimates are now just catching up. So it looks like they're cheap, but they're probably not. We wouldn't be going into Occidental or Marathon. We had our run out of Exxon. We made some money out of that. We got in at the right time on the recovery, and we're out of that. But earnings estimates up, you can see mostly Occidental, Marathon, Apache, and then down further down the list, we have some other oil companies seeing increased earnings estimates as well. On the downside, we get a swift cut in Accor. Accor is the French hotel chain. So people are not going to travel as much. We've got United Airlines earnings estimates down, Royal Caribbean earnings estimates down, and interestingly, Amazon earnings estimates down. Now, on Amazon, they make most of their money in Amazon Web Services. And when they sell products online, they generally sell it like Costco at cost. And they're not really trying to make money, but trying to gather market share. And 2 months ago, of course, we wrote in detail about Lena Khan, the new chair of the Federal Trade Commission, who is out to try to break up some of the potentially monopolistic behavior of companies like Amazon, Google, Facebook, et cetera. So what we did see here is Amazon earnings down, as they are seeing some competition from companies like Shopify. So earnings estimates down for Amazon, but it's a very, very, very thin market when you take out a very thin profit margin when you take out Amazon Web Services. So those are the major changes in earnings estimates, some ups for the oil stocks and some downs for the cyclicals like Potlatch, United, and Accor. Any questions? No. From a macroeconomic point of view, what we're seeing is an economy that is largely supported by fiscal stimulus. The fiscal stimulus is the $1,400 that was handed out to low-income people, or the unemployment insurance, and some of the other stimulus packages coming out of Washington. But that is wearing off. And so we're seeing a surge in economic activity, but we'll see that wear off and the inflationary effects of that wear off. And then we also have the Fed asset buying, which is also stimulating the economy, and the near zero interest rate policy. So these are the two stimulants for the economy. And Fed asset buying is not going to stop, and interest rates will stay near zero, because what we're seeing from the Federal Reserve Bank is that they don't expect inflation to be sticky, other than perhaps in some labor markets where we need some recovery. Vaccine policy is also helping to boost the second quarter GDP. GDP up 6.5% for the quarter. And the creative destruction is still benefiting technology, telecom, and entertainment. So where people are staying at home and doing relative value model seminars on Zoom instead of having the great catering that we have here, what we're seeing is a big change in how businesses are being done, benefiting these large technology companies. The worst affected sectors did recover the most in this quarter, although that will get a knockback on the Delta variant. But those sectors that have been recovering the most, restaurants are back up, traveling is back up, and housing is continued to be very strong. But we do see some supply constraints as we do get this recovery from the stimulus, particularly some raw materials like oil or copper. And we've seen some shortages in semiconductor, which of course is impacting the manufacturing sector and auto production in particular, where companies can't make cars, people are going out to buy used cars. So you get a very strong used car market, but those cars will wear out. And when the chips are available again, those auto production rates will increase, and you'll see some gigantic profits out of auto companies in the next year. But this year, we're seeing used car demand up as chip shortages are curtailing car production. Consumer electronics is also impacted by this. We've seen, of course, Apple rolling out their iPhone 12, which is G5, 5G enabled, and it's getting a long shelf life for their new phone. But we're seeing phones coming out from Samsung and phones coming out from Xiaomi. The Chinese company is doing very well, but they do have chip shortages and price increases. And so we are seeing some shortages in that area. Unemployment rate fell to only 5.9%, and that might look good, but there are a lot of people who haven't come back to the market and applied for jobs. So your participation rate in the labor force is still low. There's still some slack there, and a lot of people could come back to the market. And so the 5.9 is a little bit misleading. High unemployment insurance, of course, if you're given money to stay at home, you're less likely to go look for a job, even if it's less than you might make working. It's easier to play a video game. So cynical, yeah, but that's what they're doing. High unemployment insurance is preventing further improvements in that employment rate. But those will go, and people will start to get back to work. This has caused a big increase in the wealth gap. The rich are richer, the poor are poorer, particularly hurting the Black and Hispanic communities, where there's been a lot of turmoil. So this rapid recovery is causing some bottlenecks and some short-term inflation, but we do expect that in the longer term, as these labor markets, we do get higher wages, and wage increases are sticky, combined with Democratic leadership. The U.S. Democrat Party is more about helping people with lower incomes, and that should disproportionately help lower income people moving forward. So where those lower income people have been the worst hit by the pandemic, and they're not benefiting from creative destruction, we believe that going forward, there'll be a lot more support in the marketplace for low income or middle income families, and we'll see an improvement at that end of the market. So now, those are the macroeconomic points. Any questions? Kelly, would you like to ask me a question just to get the ball rolling?
What do you think about where the AUD is going?
The AUD, wow. I do comment on the banks here, and I say Commonwealth Bank is worth more than the three biggest European banks combined. Now, I take HSBC, and I say, okay, they're Hong Kong, Shanghai Bank, or they're a UK company. But if you take Barclays, Banco Santander, and UBS, these three companies combined don't have the same market value as Commonwealth Bank. So Australia has this great ability to develop a very, very large banking business. We're over dependent on them. They're very profitable, but it creates stability. And when I first came to Australia, we didn't have franking credits, and we had a very cyclical economy that was exposed to people who would take advantage of the cyclical nature of the mining industry, and you'd have these boom busts, and you'd have a lot of bad people out there running scams. Thinking of people like Christopher Skase and Bond, and some people who did some pretty bad stuff. There are a lot of stuff. Now, Australia is very stable, and I think that the franking credit system is reduced the cyclical nature, and then we import all these students from Asia, and I think that's going to be tougher. Importing students from Asia is obviously getting a lot tougher, but we have a lot to offer for Asians who want to move here from China, because we have beaches, we have open air, and we have a political system which we think is better. This is Meredith. Hi, Meredith. Interesting comments on yes. Yeah, okay. Good question. Square is a great company, and Afterpay is a company that I don't want to say anything bad about. It's a big acquisition. It's $30 billion. It's a very big price target. In the United States, Meredith, what we have are banks and then payment systems. So the biggest market cap in the US finance sector is JP Morgan. Drop the next two are Visa and MasterCard. And then we have all these other payment systems which are emerging below that, including PayPal, Square, and cryptocurrencies. So Afterpay, of course, is gone beyond Australia and has operations in the US. Now, they could be seen as a, and the way I think of them in sort of a negative way is they're like a payday lender. They're going to not charge any interest, let you pay in 4 installments, and they don't charge you anything, and they hope that you don't pay, because then they charge fees. So it's an ugly business model, and I think I get righteous here. Like, I think lottery should be outlawed, and I think Afterpay is not that great, a bit negative, but it's a good deal for Square, and I think it'll be a good acquisition for Square. So Square is very expensive. Their shares are very valuable, and they're paying with shares. So if people with Afterpay get shares in Square, hold on to them. It's a good company.
But we've kind of scratching our heads. Why wouldn't Square just develop a layaway type feature on their system in-house? They're paying a lot of money for a brand.
No, they're paying for tech. They're buying the technology and the integration into the existing system, because I think that Afterpay has good tech to integrate into the retail industry as is, and its mission. So I think there's more to it than just buying a brand name. I think they're buying the technology and the business model. Yeah, maybe. Yeah. Banks are making a lot of money on investment banking, quantitative easing. The virtuous cycle is accelerating. So low interest rates encourage companies to buy and make acquisitions. And Goldman Sachs advised Afterpay. U.S. banks are, the U.S. is a much more separated business. We've got banks, investment banks, and payment systems. And in Australia, that's all sort of combined. And the permanent anomaly, as I mentioned before, is that Commonwealth Bank is worth more than 3 of the biggest banks in Europe combined, and that is not going to go away. Goldman Sachs. So we're going to talk about this. Thank you.
So as we predicted in the earnings preview, Goldman reported per share earnings $15 a share, well exceeding, comfortably exceeding the estimate, and the actual figure was $5.5 billion, which was the second best quarterly profit ever. That was on revenue of $15.4 billion, which overall grew about 16%. Some highlights in the divisions were the investment banking division, where revenue was up 83%. So they're advising on these M&A deals, and the Square Afterpay transaction is just another example of this virtuous cycle that we've got exposure to through Goldman Sachs. They're consistently a leader in the M&A league tables, and so they're benefiting from the resurgent M&A activity, which is running year to date about 75% ahead of last year, which was obviously COVID affected, but about 20% higher than 2019 year to date. They also improved the dividend by 60%, now paying about $2, well, not about, exactly $2 per share. And another area which the bank's focused on growing is the consumer division, where revenue grew 41% in the quarter. It's been interesting to us to see Goldman Sachs stock price largely not react to the consistently fantastic quarterly earnings results. Investors are very much focused on the slope of the yield curve and the outlook for interest rate policy, which while Goldman is focusing on becoming a more consumer oriented, traditional sort of lending bank, they're far less exposed to that than some of their peers like Bank of America or Wells Fargo, for example. So a very solid result, and has helped the stock remain very strong.
Thank you, Chris. Consumer products, Reckitt, Benckiser down 15%. Here's a couple of their brands: Dettol, Harpic, Durex, and Finish. There are many others. Very tough comparisons versus a year ago, and we're avoiding these overbought companies such as Clorox, and I point out that Clorox fell 10% last night. It was up 20 to 23 times earnings. Actually, it fell 20% last night, which is after I wrote the report. Coca-Cola.
Coca-Cola reported very clean results about 2 weeks ago. They beat earnings estimates by 21%, and the stock now is approaching our target price, which are around $60. The read on the earnings call from management is that moving forward, we'll probably see some inflationary input cost increases over the next few quarters. And we'll see if that's transitory or if it's sticky. This is the inflation debate that continues. How long will this last? But the Fed is convinced that the inflation that we've seen in the last 2 months is really driven by a demand and supply mismatch. And as those two factors more align, we should see a reduction in the inflation rate, closer to the 2% target that the Fed has. But great result from Coca-Cola. This is really a reopening story. They had favorable comparables from a year ago, and they'll continue to benefit from the world becoming a more normal place again. And Joe, discuss.
Yeah, Activision Blizzard, they had management quit walk out last night, pushed out last night. Their new game plan, they had a number of employees threaten to strike over some sexual discrimination stuff going on. So a lot of volatility in Activision Blizzard. But we've also seen problems, of course, with the opium comments out of China. And I'm happy to be out of Electronic Arts now. As I've said before, there are ethical issues with investing in Electronic Arts. But Activision Blizzard down 11% this month due to corporate culture problems. Spiritual opium. Have a look if you get a chance at Billy and NetEase. These companies are Chinese companies that trade in the form of an ADR, and they're good value for money if China doesn't make gaming illegal, because they do sell those outside of China. But if you go to the websites, I can't understand much of it. Ellie can understand a lot more than I can, but I'm happy to be out of it. I'd rather own tobacco than a gaming company right now. Viacom CBS surged and then tumbled with Archegos leveraged investments. But Steve, you want to talk about?
they'll report on the 5th, so we don't have results yet, but we will get a report out when they come out in a couple of days. But what we've seen year to date is a significant amount of volatility in the stock, driven in March by the implosion of Archegos, a family office that was leveraged to the hilt and effectively controlled 25% of Viacom stock through the use of these total return swaps. And banks lost a lot of money, but the shares are still ahead by about 10% year to date for us. So at 10 times earnings, it looks like great value. They will be launching their Paramount Plus streaming offering to Australia on August 11th. And are you going to subscribe?
Well, how much is it, Steve? Is it about $10 a month?
It's about $10.
Yeah, okay.
I'll probably subscribe. Okay. I'll hand it to Chris for the actress.
Thanks, Dave. So Beatrice, the merged Mylan and Upjohn, a division of Pfizer, will report next week. And this is a company that's starting to make progress on the strategy that underpinned this merger. The last quarterly results, they maintained their financial guidance for the year. They accelerated the expected realization of the cost synergies, and they initiated the long promised dividend. So they're committed to paying out a decent portion of free cash flow as a dividend. So we'll look for more progress on that strategy and for debt pay down. The stock is trading at an extremely depressed valuation, less than 4 times forecasted earnings, and pays a 3.1% dividend. Continuing in the healthcare space, Amgen reported earnings last night, and it was a very clean result. We had revenue growth of 5% and per share earnings growth of 4%. There was a bit of give and take among the various drugs. Some pricing and competition for some older drugs was offset by some better competitive positioning and pricing of more recent launches. And this speaks to their nice diverse portfolio of drugs, which and having a good pipeline to constantly replenish the portfolio of patented drugs, because companies in this industry are always facing patent cliffs. So a very good, clean result, maintained revenue and per share earnings guidance for the year, and one of the more promising drugs, which will be released in the near term and recently received FDA approval, is a lung cancer treatment. So looks like a very good reward to risk proposition at a compelling PE 13.6 and a nice dividend yield. And finally, Medtronic, the implantable biomedical device business. They have a different fiscal cycle, and they report towards the end of August. But results from some of their peers who appeared on the movers, or Waters, I think did at least, are a good indicator for Medtronic's results. We're seeing a lot of customers like hospitals investing in consumables in anticipation of the post-COVID resumption of procedures.
Alphabet knocked it out of the park again, and actually bucked the trend that we saw among the largest cap technology firms, in that it traded up following its earnings result. Revenue came in ex traffic acquisition costs, which is the fees that they pay handset makers like Apple for directing traffic through Google search on their devices. Revenue came in at $51 billion versus the $46 billion estimate. YouTube revenue jumped 84%. Now they've only recently started breaking out the YouTube numbers, but this makes YouTube one of the largest media and entertainment companies, if it were a separate business on its own. Digital advertising, of course, was the major driver of sales this quarter. And what we're seeing is a push by retailers to sell online. And this has been accelerated by the COVID lockdowns. And we think this will remain the growth area in retail. Brick and mortar is dying. Profit came in at $27.26 a share, well ahead of estimates of $19.35. And the shares have surged on this news. It's been an excellent investment for us, up about 425% since we first bought the stock back at $515 a share, and at 23 times earnings with 30+% revenue growth. This still looks like a great buy. They had $18.5 billion in profit, which makes them, I think, the second most profitable company in the world in history, behind Apple, which had about $22 billion in profit for this quarter. Qualcomm. Feel free to interrupt us with questions. We're happy to field any questions you may have. Qualcomm had an excellent result, 63% growth in revenue, and they guided higher for the next 2 quarters, which was received positively. The shares are now tracing back up to their January level. Earnings per share in the next quarter will be $2.15 to $2.35. This is well ahead of the previous guidance. And the management highlighted the diversification of their revenue streams. About $10 billion in annual sales will now come from other products and services outside of their CDMA technology and their licensing business. So that's about a third of rev. On to Chris to discuss Boeing.
Thanks, Dave. So Boeing, in a year that's been described as an inflection year or reset year, had unexpectedly good quarterly results. Sales 17 billion exceeded 16.6 estimate, and a highlight in there was 6 billion of commercial sales, which more than doubled from the year ago. And the commercial division is of course the one that is experiencing the issues with the 737 MAX and 787, and has been most adversely affected by COVID. If we wind back to a pre-COVID and pre-737 MAX problem world, Boeing was a company that generated $100 billion in sales, and about 30% was from the government defence, which has been very stable and grown marginally over the last 3 or 4 years. And that has helped carry the business in terms of revenue and cash flow and profit, while they deal with the challenges in the commercial division. So this quarter, all in all, demonstrated good progress in the turnaround. Some highlights beyond the revenue and EPS were the improved margin in their services division went from 12% to 13%, and also improved margin in the defence business from 6% to 14%. In sum, Boeing's dealing with 3 challenges: the recertification of the 737 MAX, which has occurred in most jurisdictions now, notably not yet in China, although there will be pressure there to get the plane back in the skies to accommodate the influx of travel during the Winter Olympics. The 787, the Dreamliner, and of course COVID. So Boeing's making good progress on all of those fronts. There's been, I mean, it's like Boeing doesn't have enough to deal with at the moment. There is a renewed focus among, well, I suppose there's always been focus efficiency, and making planes lighter and more sustainably powered. But there's speculation around what the new models for Boeing might look like. They haven't committed to any drastic changes, but jet engine manufacturers are starting to look at potentially hybrid or alternative fuels sources. So we'll see what plays out, but the cost of developing a new plane would be somewhere around 15 billion. And Western Digital report earnings this evening. This is the most recent addition to the relative value portfolio, and we are quite optimistic around the results because the CEO, who was installed about 18 months ago, has focused on improving the cost structure in the business, and also collaborating more closely with what they describe as cloud titans, and with Amazon, Microsoft and Alphabet having all reported earnings for the second quarter and results for their cloud divisions. We are very heartened that a good result is installed for Western Digital. I might hand over to Joe for some concluding comments.
Well, good news, we're going to finish early today. Our model portfolio is unchanged with Goldman Sachs doing very well. We're very pleased. I think they're the smartest bunch of people on Wall Street, and they know how to make some money. Coca-Cola's our COVID recovery trade, not our reflation, but our COVID recovery trade, and they are doing well. The Delta variant could reduce participation in some events, such as sporting events and concerts, but hotels seem to be opening up. There was news today that New York is considering requiring proof of vaccination to go to restaurants. And that is concerning, that people would have to disclose their health status to be able to go to a restaurant, but that's the way the world is going. The Viacom CBS, pleased with that investment. It's a dynamic industry that is launching in Australia, but we have this problem with the Redstone family still controlling the majority of the voting stock, and that prevents it from being taken over. If it was not restricted in the voting stock, the stock would be worth twice what it's trading at today. Viatris is going sideways. We'd like to see it do better. Very happy with Amgen. Medtronic, very happy with Medtronic. Alphabet is very happy with that. Western Digital, the new addition, earnings coming out tonight, and Qualcomm is excellent. They're in absolutely the right place for the 5G rollout, and the demand from, as I mentioned earlier, Samsung, Xiaomi. Xiaomi, I think, is now the second largest handset provider in the world after Samsung, and then iPhone 3, or they're all fairly close.
They're pretty close. Google has a phone, the Pixel.
And Google, but that's not
It's very small market share. But,
getting the, but
you know, interestingly,
it's not creating the demand for the Qualcomm chips. So
no, and that's a good point, because in the earnings call, Alphabet disclosed that they're going to stop using the Qualcomm chip in their future Pixels, and they have developed an in-house chip called the Tensor, which is a trend we're seeing across tech, where a lot of companies are going in-house for their semiconductor needs.
I think that's going to be tough. I think designing a chip is hard to do, and I'm confident that they might have to come back to Qualcomm later. So I'm happy with Qualcomm on that. And Boeing also is a recovery, not a reflation trade, but a good recovery trade. We still have the supplementals in Baidu and Alibaba, but we're out of Tencent, and there's some good long-term performance. I'm pleased to say we're finishing a little earlier today. We would like to have some more questions and answers, and we're happy to stick around. Thank you.
Thank you, Joe. A replay of today's webcast. Oh, actually.
You're welcome.
Thank you.
Thank you. So a replay of today's webcast will be made available shortly after the conclusion of this event. Listeners with additional questions can contact myself or the team via phone and email as per the contact information available on our website. And that does conclude today's presentation. Thank you for joining us. We appreciate your time and we look forward to speaking with you again. You may now disconnect.